Hello and good afternoon. Welcome to Small Business Payroll and Cares Act. We will be having a guest speaker today with the Small Business Development Center. Our guest speaker for the day is Tanya Luken, and we're going to provide a few more minutes for everyone to log in. I see that we have quite a few people signed up. So in the meantime, a couple housekeeping items. If you have any comments, as Melinda did for Tanya, please feel free to put those comments in the chat. If you have specific questions that you would like Tanya to answer, please use the Q&A box. The Q&A will help us keep track of your questions so they don't get lost in our chat box, and make sure that we answer them in a timely manner. All right, just a few more moments here to allow everyone to log in who signed up. We did have quite a few people register. And again, welcome for those of you who are just joining us to Sbdc Small Business Payroll and Cares Act. Our guest speaker today is Tanya Luken. So Tanya, if you want to go ahead and take it away.
Sure. Hi, everyone. My name is Tanya, and I'm a CPA that doesn't do taxes. But today I'm going to tell you more than you ever wanted to know about small business payroll and the CARES Act. And we're going to cover a few different things. I'm going to try to make it as understandable as possible. But if you do have questions, please do put them in the Q&A, and then we'll get them answered either while we're on the call today, or I'll reach back out to you, okay? And then about me, I started my first practice. I'm kind of a little bit embarrassed to say this, but it will be 20 years on May 3rd. So I'm kind of excited at the same time, but then I don't feel that old, so I don't know where the time has gone. But please let me know if you need anything while we're going through this. All right, so one quick disclaimer. Basically, I'm here to give you some information about payroll and payroll taxes, and this is not designed to be specific tax advice for you as a taxpayer. If you do need specific advice, please ask for it in writing from whoever is giving it to you. These are a few things that we're going to cover today. I know this list looks long, but I wanted to divide it up into sections so we could cover a few things at a time, and then we'll stop and answer questions. So the first thing we're going to talk about is what's an employee and what's a contractor and what are joint employers. We're going to cover new hire paperwork that you need, exempt versus non-exempt employees, the Arizona sick leave, workers' compensation, how you calculate payroll, how you work with the payroll company, the new 1099 NEC form and the 1099 miscellaneous income form, the Ppp and Cares Act, and finally the employer retention credit. One other thing I wanted to make mention of is payroll terms, so that we're going to use a couple of terms throughout this presentation, and I want to make sure that you understand what they are. So the first is Fica, which stands for Federal Insurance Contributions Act. It's deducted from an employee's pay at 7.65%, 6.2% is for Social Security, 1.45% is for Medicare, and it's matched by employers dollar for dollar up to the Social Security limit, which changes every year, but it's over $100,000. EE in accounting language means employee, ER means employer, FUTA stands for the Federal Unemployment Tax Act, SUI or SUTA stands for State Unemployment Insurance or the State Unemployment Tax Act. I say SUI. IRS, our favorites, the Internal Revenue Service. ADOR is the Department of Revenue in Arizona, and DES is the Department of Economic Security. I remember the first time I ever got a job, and I got my paycheck, and I went home and I showed my pay stub to my dad, and I'm like, what's a Fica? I don't understand. Where did all my money go? So I love that Fica. All right, so roughly, this is how payroll works, okay? So let's say you have an employee that earned $100,000, or I'm sorry, earned $1,000. They're going to have $62 of Social Security come out of their paycheck. Then they're going to have $14.50 of Medicare come out of their paycheck. And then based on whatever they put on their W-4 and A-4, they're going to have federal withholding of $10 and state withholding of $3 for a net pay of $910.50. What happens behind the scenes is the employer will match the FICA at $62. It will match the Medicare at $14.5. It will pay federal unemployment, which is $8, and it will pay state unemployment, which is $23. So when this employer agrees to pay an employee $1,000, the employee is going to get $910.50, but the employer is going to pay out $107.50 in taxes, plus all of these amounts that were deducted from the employee's paycheck. So this employer is going to give out $1,107.50 of cash when they agreed to pay someone only $1,000, okay? This right here is the reason why people want to make workers contractors instead of employees. Because if you are a contractor, all of the things on the right-hand side and all of the things under the $1,000 go away. You just write someone a check for $1,000. So let's talk about that. Employees versus contractors. So these rules literally will change on May 7th. It was supposed to change on March 8th, but they've pushed it to May 7th. There's 3 types of rules. There's behavioral control rules, financial control rules, and the relationships of the parties, all right? These 3 tests are how you determine if someone's an employee or someone's a contractor. You have to use your best judgment and document your understanding. So first, behavioral control. It's the right to direct or to control how the worker does the work, when and where they do the work, the tools and equipment they use to do the work, the supplies and services they use, who controls the work and who trains the worker. So let's use some examples. So let's say that I'm looking for a new employee and I call Laura and say, Laura, will you come and work for me? And she says, sure. Where should I go? And I say, come to my office. And then she says, should I bring my own computer? And I say, no, I have a computer for you. And she said, should I bring my own pens and pencils? And I say, nope, we've got those here, right? She shows up, I hand her a pile of work and I say, I need you to follow this accounting procedure for this client and do all of this work. This is how you do it. I sit down next to her, we go through it together, we do it together. In this instance, you can see that I'm exerting a lot of behavioral control over how Laura would do the work for me, right? So think about another example. Let's say that Jeff Bezos calls me and says, Tanya, can you come help me do my accounting? And I say, yes, I can. So I go to the Amazon headquarters and I'm going to do all the accounting for them, okay? In that instance, is he going to necessarily tell me like, hey, Tanya, this is how you do accounting? Likely not. Like, I'm going to be able to say, this is the system we should use and this is how we should do it, right? So in that instance, there's not a lot of behavioral control when you think about hiring an expert, okay? All right, financial control. Who directs or controls the business aspect of the work? Is it an employer with employees or an independent contractor who are in business for themselves? I put a note here about the economic reality test. That's the new rule, and we're going to talk about that in a minute. That's the one that starts in May, okay? The factors include a significant investment, unreimbursed expenses, an opportunity for profit and loss, are there services available to the market, the method of payment, and the degree and nature over the control of work. So let's talk about those factors. A significant investment. So let's say I own a ditch digging company, right? And I go out and I buy a backhoe and then I hire somebody to come and drive my backhoe and dig a ditch, right? For my government contract. In that instance, like I've created a significant investment because I bought that backhoe, right? What if somebody comes to me and says, hey, Tanya, I have my own backhoe. I want to dig a ditch for you. You see what I mean? That's the significant investment part. Like, so my relationship in my first example with the government, I'm a contractor because I own the backhoe, right? In the second example, because I own my own backhoe, my relationship with the government, I'm a contractor, but the person I hired to drive the backhoe and do the digging, that person is likely my employee because I own the backhoe, okay? Unreimbursed expenses. So for example, let's say that you need pens and papers and printer or scanner to do all of your work. Are you expected to be reimbursed for those items? Opportunity for profit and loss is a big one. And the rules around this are changing as part of that economic reality test. But basically the opportunity for profit and loss is, can you go out and solicit new business, new contracts, new customers, new clients, and generate more revenue for yourself? Do you have that kind of entrepreneurial opportunity for profit or loss? And then are your services available to the market? Can anybody go out and hire you? You know, do you have a trade name? Did you form an LLC? Any of those kind of things. Method of payment, it doesn't necessarily mean like you can't pay someone on a regular schedule. It's more like, are you writing them a paycheck with withholding? And the nature and degree over control of the work. This is kind of back to those control tests, and we'll talk about those again in a minute because that's also changing. So next, the relationship with the worker. Is there a written contract? Do you provide the worker with benefits such as insurance or a pension? Does the worker provide key services that are important to your business? Is the work expected to be permanent? And technically, you can go to the IRS and fill out an SS-8 form, and they'll tell you how to classify a worker. I wouldn't necessarily recommend it, but if you get stuck, it's an option for you. So even with all of these things, you know, having a contract, not providing, you know, like if you provide insurance or a pension, it's more likely that person is going to be an employee. Key services that are important to your business. That's one other thing, like if your business isn't going to survive without that worker, then you're back to that economic reality test. So these new factors, they talk about the amount of skill required to perform the work, the degree of permanence in the working relationship between the worker and the potential employer, and whether the work is part of an integrated unit of production, which is a little bit harder to understand. But when you think about the overall product that you're delivering or service to the market, if there's a part that's integral to that offering that you provide, then you're more likely that person is going to be an employee and less likely they will be a contractor. The actual practice of the worker and the potential employer is more relevant than what may be contractually or theoretically possible. So in this example, let's say that I get a government contract to dig a ditch, but I don't own a backhoe, right? So then I decide that I'm gonna go buy a backhoe, and then I'm gonna hire someone to drive my backhoe and dig the ditch, right? So even if I hire that person and tell them, hey, you're a contractor and we have an agreement that they're going to be a contractor, I would say that that person is probably not going to meet the economic reality test. They probably, well, they have the skill that's required to do the work, whereas I do not. And I expect the relationship to be permanent as part of that contract. So I think that in that instance, that person would become an employee of my company. Okay, make sense? I had a tax professor in college that always used to say clear as mud. So, all right, so now you've decided, you understood all those rules perfectly, and you've decided that you have employees. So what you have to do is collect new hire paperwork. So what you're required to collect is a W-4, which basically tells employers how much withholding to deduct from their employees' paychecks, an A-4, which talks about the Arizona withholding amount, an I-9, which proves eligibility to work in the United States. Then, as an employer, you're required to use the I-9 information to eVerify employees. Here in Arizona, eVerify is required. You're also required to do new hire reporting. And basically you do new hire reporting because in case someone should have a judgment or child support or something else against them, that's how the government would find them, is through new hire reporting. One thing I want to mention is eVerify. You have to sign up for it. It takes a hot minute, so sign up. There used to be a little quiz. I think there still is. It's pretty easy, but there's some, it's going to take you a minute. So if you're thinking about hiring employees, get set up on eVerify now so that you're ready to go, because you have 48 hours to eVerify someone after you hire them. And then Arizona New Hire Reporting, that website looks super duper fake. I'm just going to tell you, it looks like you're literally going to the dark web and putting someone's social security number on there. So I'm just warning you that it does look very strange, but that is the website. And then I suggest that you have them fill out an application and sign it. You collect their emergency contact information and you give them an offer letter documenting how much and how often you're going to pay them. In Arizona, the Department of Economic Security is the one that regulates Arizona hiring and employee work. And they require that you collect the new hire forms, that you also keep check stubs and canceled checks for payments. You have check registers, a payroll journal that shows the gross to net pay calculation. Remember how we talked about that employee got $1,000 and then they had $910 left over? That is the gross to net calculation. Then there's payroll tax reports. There's quarterly reports and annual reports. You need your W-2s and a W-3. And for each employee, the beginning and ending dates of the pay period, the total amount that they're being paid for all services, and the date in the week with the largest number of employees worked. So let's talk about a couple of things. First, direct deposit. Everybody loves direct deposit. So if you do direct deposit, you don't have to keep a check stub or a canceled check because it was sent remotely. All payroll companies or providers that offer direct deposit services will have some kind of report that shows who got what pay. Check registers, the same. All of these records can be kept electronically. You do not have to keep paper copies. Most of you should be familiar with the W-2 because you may have received one in your life. A W-3 is just a big W-2 that employers submit that says, I'm sending you X number of W-2s that total this much. All right. A couple other records that you have to keep. And this is shocking, but true. You need to know the first and last name of all your employees. You need their social security number, the date they were hired, the date they were rehired or returned to work, the date they were terminated, their separation date and their reason, the amount that they were paid each calendar quarter, how much they were paid each pay period, and the amount and date of any special payments, which would be like bonuses, and where the services were performed. Okay? All right, exempt versus non-exempt. So this is a really fancy way of saying salary or hourly. So exempt employees are exempt from overtime or salaried. Non-exempt employees are not exempt from overtime and they are hourly. For non-exempt employees, they're hourly and they're paid 1.5 times their regular rates of pay for any time in excess of 40 hours in a payroll work week. You as the employer determine the payroll work week. You say my payroll work week is Monday to Sunday, Sunday to Saturday, Wednesday to Tuesday, whatever works for you, you're allowed to choose it, document it, and share it with your employees. I don't think you should do flex time. 42 hours in week 1 and 38 hours in week 2 is not 80 regular hours in a pay period. 2 hours are overtime. So in that instance, you would pay 78 regular hours and 2 overtime hours to that employee if they were on a biweekly payroll. Everybody has to be paid minimum wage, and in Arizona, as of January 1st, it's $12.15. And if employees make commission, they still must meet the minimum wage requirement. Okay, exempt employees. So exempt employees, remember, they're exempt from overtime and they're exempt from minimum wage. Their pay is a predetermined fixed salary, not based on the quality or quantity of work, okay? But they have to perform certain duties. They have to be an executive, an administrative, a professional, outside salespeople, or certain computer employees. For example, if you're an auto mechanic, you cannot be, you should not, it's against the law to be salaried, okay? So if you run a garage, your mechanics cannot be salaried. Salary has to be more than $455 a week or $23,660 a year. So I just want to tell you, a couple years ago, and when I say that, it was maybe like 5 or 6 years ago, there was a new, the Department of Labor, for the US Department of Labor, or the federal office, they had decided that this 455 needed to change and they were going to raise it to 900 and something. So it was enjoined in a Texas court, meaning that some chambers of commerce got together and they filed a lawsuit against the government, and the judge agreed with the Chamber of Commerce and told the Department of Labor they couldn't change it the way that they were doing it. So it's stalled there. I just want to tell you, because I feel like there's a lot of things that are going to happen in this new administration that we have, and there's a chance that this 455, it could come back around and change again. The push to do it was because that number it hasn't changed since like the 60s or something. Okay, joint employers. So this one, we're going to use examples to understand this. So if you don't get it from this first part that we talk about, we'll do the examples and it'll be clear as mud. So there's 4 factors to determine if you're a joint employer. So, but I'm going to add like a question that you have to ask yourself before you start into the 4 factors. So the first question you ask yourself is, do you have more than one business? And if the answer is yes, then you go on to the 4 factors. If you said yes, do you exercise the power to hire and fire employees? Do you supervise and control the employees' schedules or the conditions of their employment? Do you determine their rate and method of payment? Excuse me. And do you maintain the employees' employment records? Okay. So basically, do I own more than one business? Do I hire and fire a lot of employees? Do I make schedules and boss a lot of people around? Okay. I am kind of bossy, but I only have one business. So I'm not a joint employer. But so let's look at this example. Let's say an individual works 30 hours a week as a cook at one restaurant establishment and 15 hours a week as a cook at a different restaurant establishment affiliated with the same nationwide franchise. These establishments are locally owned and managed by different franchisees that do not coordinate it in any way with respect to the employee. Are they joint employers of the cook, right? So let's pretend I'm a worker. I work 30 hours a week at the Subway in Tempe and 15 hours a week at a different Subway in Chandler, and both Subways are owned by 2 different people. So what do you think? Joint employer? Nope, they're not. So let's pretend now I work 30 hours a week at a Subway in Tempe, and that's owned by Bob Smith, and Bob Smith also owns a Subway in Scottsdale, and I go work for 15 hours at his Subway in Scottsdale. So now is Bob a joint employer? Yes. So in this example, if you work 30 hours, it's a joint employer because Bob owns 2 restaurants, and they don't have to be restaurants. They're 2 businesses where Bob controls the work of the employee, controls the schedule, controls the hiring and firing, okay? In this example, because I worked for a joint employer, I would be paid 5 hours of overtime because I worked 30 hours at one store, 10 regular hours at the second store, and then 5 hours of overtime. Okay, all right, Arizona sick leave. So you guys may remember this, Prop 206. It passed a couple years ago, and there's been a lot of things to see if we could stop it from happening, but I think it's here to stay. So there's 2 sets of rules. One, if you have 15 or more employees, and one if you have fewer than 15 employees. So do you remember when we were talking about the information that you were required to keep? And one of them was the day of the week with the highest number of employees. That's how you count this. So at this moment, I'm an employer in Arizona and I have 6 employees. So I fall into the right-hand side of this. I accrue 1 hour for every 30 hours my employees work. They are not entitled to accrue or use more than 24 hours per year of sick leave. Employers can select a higher limit. So for example, I offer my employees up to 2 weeks of paid vacation. So that's a higher limit than what Prop 206 requires. Employers can select a 90-day waiting period, so I can make it so that my employees are accruing hours for the first 90 days that they work, but they can't be paid for their sick leave. I can't deny them sick leave, They can take it unpaid, but they have to wait to be paid for their sick leave. The balances can roll forward, but I don't have to pay them out when they leave employment. Then for 15 or more employees, you accrue 1 hour for every 30 hours still. Employees get to accrue up to 40 hours a year. So the only difference between the two is how much paid time off or paid sick leave your employees can accrue. So if you have more employees, it's more hours, fewer employees, less hours. Okay, workers' compensation. See, all this is so exciting, right, you guys? Under Arizona law, it's mandatory for employers to secure workers' compensation insurance for their employees. Workers' compensation is a no-fault system in which an injured employee is entitled to receive benefits for an industrial injury, no matter who caused the job-related accident. You can obtain workers' compensation insurance from any insurance company that's licensed to issue workers' comp policies in Arizona. Employers are required to carry coverage regardless of the number of workers they have, part-time, full-time, minors, undocumented workers, or family members. It's not required for independent contractors if the contractor has their own coverage. Okay, let's talk about a few things here. Have you guys ever been to the car wash and that guy comes up and wants to fix the rock chip in your window? So that, we used to do a lot of work with those companies when I was first starting out, and that stuff that they squirt into your windshield, it's called resin and it's flammable. So there was a guy and he decided that he worked for one of my clients, and he decided he was going to show off for a girl at the car wash. And so he squirted this resin on his hand and then he lit his hand on fire, literally. So my client's workers' comp policy had to pay for his burnt hand because even though he was a big dummy and lit himself on fire. So when we say no fault, it is literally no fault. So the other thing that I wanted to talk about, even with family members, you have to have workers' comp coverage, okay? About the independent contractors. So if you hire an independent contractor and they don't have workers' comp coverage, your workers' comp carrier will make you provide coverage for them. If you, however, business owners can waive their own workers' comp coverage. So I have workers' comp coverage on my employees. You know, they could get a paper cut in our accounting office, right? Get gangrene and their finger can fall off or something, I'm not sure. But so I have workers' comp coverage on my employees, but I don't have it on myself. As an owner of my own business, I can tell my insurance company, I don't want you to cover me for workers' comp. If something happens and I get a paper cut and gangrene and my finger falls off, whatever, you know. So if you hire someone that is a contractor to you, but they own a business of themselves and they don't have a workers' comp policy, because they're an owner, you can still collect documentation from them that will prevent you from having to cover them, okay? Your insurance company will help you with what that documentation is, because everybody's a little bit different. Okay, so how you buy workers' comp is you estimate the total payroll costs for the year. So I sit down whenever my plan's going to renew and I look at how many employees I have and how much money they're going to make. And then I figure out how much they're going to make in a year. Okay. You describe the industry of the employer and the job duties of each employee. You pay the premium throughout the year based on the workers' comp rate of X dollars per 100, which is just a fancy way of saying a percent. There's experience modifiers, like how many previous accidents have you had? Did you hire some big dummy that like went and lit himself on fire, right? Industry modifiers, which are considered dangerous industries. So for example, my workers' comp coverage for my accounting employees is completely different than a restaurant, for example, or think about like a mine. So Then there's surcharges, fees, minimum premiums, monthly fees, and statement fees. And pretty much from that list of what is included in your premium, you only have a lot of control over number 4, okay? Anyways, so you say, this is how much my payroll is going to be for the year. And then at the end of the year, you receive an audit, which isn't as scary as it sounds. Basically, for a workers' comp audit, if you estimated your payroll to be $100,000 for the year, and it was actually $75,000, you're going to get a refund. If you estimated your payroll to be $100,000 and it was actually $150,000, you get a bill. In each instance, the carrier will adjust your new payroll estimate to be the prior period audit. If you're a growing company, reporting your payroll increase to the carrier during the policy year or save money for the bill. So let's say, for example, that, let's say that you own a restaurant in Tempe, okay? And you have 12 employees that work at your restaurant, and you've decided now you're going to open another restaurant in Gilbert. So it's the middle of your workers' comp year. As we learned with the joint employer, everybody's all covered the same. So you decide, okay, I'm just going to go open this new one and not tell my insurance company that I'm doubling the amount of payroll I'm going to have. So when your policy premium comes up, you're going to owe a lot of money because you have twice as many employees as you had when you started the plan year. However, you can call your insurance company and say, hey, I just doubled my payroll. Can you increase my monthly premiums? And they will absolutely do that for you. Okay. I've helped a lot of businesses open restaurants for the first time, and we tend to underestimate workers' comp audits, knowing that a year from now, we will have better cash flow to pay that workers' comp bill. All right, calculating payroll. This is the good stuff, all the math. All right, so we're gonna take 2 employees. So the first employee put on their W-4 that they're single and 0. And the second employee put on their W-4 that they're married with 3 exemptions, okay? We agree to pay each employee $1,000 for whatever time frame. So their Social Security and Medicare amounts are the same because those are all the same for everybody, 7.65% combined. The employee that's single has $30 withheld, and the employee that's married had $10 withheld for federal withholding. State withholding for the single employee is $10, and state withholding for the married employee is $3. So you can see their net pays are different, right? The employee that's married is going to take home more net pay, right? The payroll companies do all that calculation for the amount of withholdings, okay? The employee's gross pay was the same, but their net pay was different because the employees chose to withhold more or less. Social Security and Medicare are the same because it's based on the same gross pay. It's the same $1,000, right? Payroll expense for this company is $2,000, not $1,794. So going back, it's $2,000. These gross pay numbers, not the net pay numbers. The employer is responsible for the payroll taxes. So the employer is going to match the FICA, the Medicare and Social Security, plus they're going to pay the federal and state unemployment. The company is responsible for paying the employee withholdings and the payroll taxes to the IRS, the Department of Revenue, and the Department of Economic Security. So in this example, all of this money, both $62 that came out of the employee's paycheck plus 2 matches, both the Medicares and Social Securities that came out, both $1,495 plus 2 matches. So then the employer is sending 8 sets of money to the IRS, okay? Along with the $30 of federal withholding and the $10 of federal withholding, all of that goes to the IRS. Then the state of Arizona gets $13, and then they'll get the unemployments. Payroll tax deposits. So this money has to go to all of those appropriate agencies, all three of them. Do you see what I did there? All three of them, by the 15th of the month following the month of the payroll. So right now we're in March. So when March ends, all payroll taxes are due. Most payroll taxes that were for paychecks that employees got in March are due by April 15th. The IRS will tell employers how often to send the money, and the state will follow what the IRS says. The SUI and the federal unemployment are quarterly. So basically, if I write a paycheck to my employees get paid twice a month, on the 5th and the 20th. And so on their March 5th check and their March 20th check, I have to pay their payroll tax deposits by the 14th of April, okay? For their February checks, I have to make the payroll tax deposits by Monday, which is March 15th. All right, some more about payroll taxes. Payroll taxes for federal unemployment and SUI end at $7,000 of annual wages. It's called a wage base. A full-time, year-round employee will hit the wage base limit in April or May. Payroll costs will always be more at the beginning of the year. If you have high turnover, you'll pay more in unemployment because the $7,000 annual wage base is per employee. As a rule of thumb, for service-based businesses, for each dollar in gross pay, there's 10 cents in payroll taxes and workers' comp, but that's averaged out throughout the year. Restaurants and manufacturing companies, remember we talked to the dangerous industries, those will have a higher workers' comp premium, so 10% is probably too low for them. So if you hire an employee and let's say you pay them $3,000 a month, so they get $3,000 in January, $3,000 in February, and then in March they're going to have $9,000 of total pay, but you're only going to pay unemployment on the first $1,000 of that March payroll. Do you see what I mean? Let's say that employee then leaves in March and we hire somebody else in April. Then it starts all over again. So then you pay unemployment on their $3,000 for April and for May and $1,000 into June. Make sense? Okay. All right, forms and due dates. Maybe. There. So these are the payroll tax forms that are due. The first three, the 941, the Arizona QRT, and the UC018 are due every quarter, and they're due by the last business day of the month following the end of the quarter. So for example, we're in first quarter. First quarter runs January 1st through March 31st. Payroll tax reports are due to the IRS, the Department of Revenue, and the Department of Economic Security by April 30th. W-2s and that W-3, which is the giant W-2, and Form 940, which is the federal unemployment tax, both of those are annual returns and they're due January 31st. Okay. These two middle ones, the Arizona QRT and the UC018, those are Arizona returns. The other ones are all federal. All right, working with a payroll company. So I want to say a few things here. Like payroll is, payroll's complicated. And probably if you get nothing else out of today, like I would encourage you to hire a payroll company. Like this is their job, but then some things we'll talk about other things that they do and whether or not you feel like you might need them. But payroll is complicated enough that if you mess it up, you're going to be in a lot of trouble. And it's not, in my opinion, it's not worth the risk. Like this is one place where you spend the money to hire the expert. But let me tell you how to get a good deal. So hire a payroll company to calculate your payroll and remit your payroll tax deposits and file all of those required returns. If there's a missed payment, the payroll company will pay the penalties and interest, but you still would pay the tax. So let's say that they calculated a tax wrong. State unemployment happens all the time with SUI. So if you, let's say that you owe $200 in state unemployment, but the rate was wrong and you actually owe $300, the state unemployment department, DES, is going to come to you and say, hey, you owe us $300 plus $35 for penalties and interest. You will pay the $100 difference for the payroll tax, and the payroll company will sort out the $35. Okay. The best part about a payroll company is if you receive a notice in the mail, you just send it to them and they deal with it, even if you change payroll services. Okay. So if they filed your payroll taxes, for example, in 2020, but you have a new payroll accountant or payroll company in 2021, you still send the notice to your 2020 payroll accountant if you got payroll company. Okay. Sorry, my dog is waking up from her nap. Okay, so fees that you pay a payroll company are based on the frequency and the number of employees that you have. Some companies, you have one person that's assigned to you. Some companies have 800 numbers. They all have add-on services. And what I mean by add-on services is they offer workers' comp, they offer HR services, they offer payroll retirement plans, 401ks or IRAs or things like that. They offer all these other types of services. You don't have to buy any of those other services. You can just buy payroll from them, okay? Maybe you'll need it, maybe you won't. I remember a long time ago, one of the payroll companies started offering workers' comp services, and they call it a pay-as-you-go program. So if you had $1,000 of payroll, they would charge you whatever the workers' comp was for $1,000, which seems like great, like then you don't have a big audit premium at the end of the year. This seems great, but then they would charge a $7 fee every payroll, which to me is ridiculous. Like it's so worth not, because you're paying an extra $14 a month to your payroll company to avoid having to fill out a form once a year. So just be careful there. Like there's if you're buying it, know what it's going to cost you and the value that it's going to provide. Overall, like with payroll companies, pick the company that makes you feel comfortable. Pick the one that answers the phone, responds to your emails, shows up at your office. However, just pick the one that makes you feel comfortable. And I've been doing this, like I said, for about 20 years, even though I don't look 20 years old. but when all payroll companies work generally the same. So how you work with them is you go to them and you say, hey, my employee made this much money, however much it was, okay? And you tell them in a manner of your choosing. So you get to choose. Do I want to go online and put in the number? Do I want to email it to you, or be total old school and send it via fax, right? Payroll's then calculated, and you remember in all of our examples from our $1,000 down to our $900.10, or our $1,000 down to the $883, all of that is done by the payroll company. And then paychecks or direct deposits are generated for your employees. So usually direct deposits, right? So then the payroll company will go into your business bank account the day before the paycheck date and will suck out all of the net pay. So do you remember our two examples where the employees each had $1,000 and one was single and one was married and their net pay was different? So if those were our only two employees, if my paycheck date is Friday, tomorrow, today, this morning, the payroll company would have gone into my bank account and taken out the $1,700 for their net pay, right? Tomorrow, on the paycheck date, the payroll company will take out all of the payroll tax deposits plus their fee, okay? So they're gonna take out all the money the employees had withheld, plus all the money the employers are gonna match, plus whatever their fee is, okay? So they're gonna divide it up. Usually there'll be 3 transactions. Sometimes if you have garnishments or the workers' comp service, all of those will just add more things on. Okay, couple of other things. First, Make your pay period end on a day that makes sense for you. Sunday is very common, okay? Leave yourself time to calculate the hours, gross pay, and to report the payroll. And make sure that the date is 4 or 5 days after the pay period ending date. So, for example, your pay period could end last Sunday, right? I don't have a calculator. I don't have a calendar in front of me, but let's say Sunday was the 8th, right? So if my pay period ends on Sunday, I'm going to have paychecks ready for everybody by Friday, which gives you time to calculate how many hours people had, if there's any commissions that they're owed or things like this. Give yourself time. Arizona employers must pay their employees at least twice a month, no more than 16 days apart. So, and you can't have, and within 5 days of the end of the pay period. So remember how I told you that I pay my employees on the 5th and the 20th? So my pay periods run the 1st through the 15th with checks on the 20th. So 5 days later, I built in that buffer. Then their next pay period runs the 16th through the 31st with checks on the 5th. Okay, again, I built in a buffer, and their pay period is 16 days, right? If your pay date falls on a Saturday or Sunday, make your paycheck date the Friday before. All right. Okay, miscellaneous and NEC forms. So 1099s are used to report certain types of payments that are made during the course of your business. The forms are due to the recipient by the 31st of January for the prior year. So we just filed in January of 2021 all the forms for 2020. IRS copies are due also by January 31st, unless you file electronically with the IRS, and then you have until February 28th, only for the IRS copies, not for the recipient, not to the person you paid. Okay, so what form do you use? The 1099 miscellaneous income form, it stands for miscellaneous income, and you report royalty payments, rents, other legal settlements, and other types of income. My favorite is box 5, certain types of fishing boat income, right? Then a 1099 NEC is what we call it, non-employee compensation. And this form is used to report payments made to people that provided services to your company that were not employees. You report payments for legal services here. So I just want to make a distinction. So if you go hire a lawyer to form an LLC or a corporation for you, it goes on a 1099 NEC form. If you have to pay a lawyer because there was a settlement in some lawsuit that you were a party to, and you had to pay a lawyer, those are legal settlements, and that goes on the 1099 miscellaneous form. For each one of these forms and boxes, there's certain thresholds of dollar amounts that you have to report here. So for example, royalty payments, if you pay someone royalties more than $10, you put it on a 1099 miscellaneous form. Most payments are $600, okay? You collect a W-9 from people, and I'm sorry I didn't put one in the slide, but we can pull one up at the end if there's time. But basically a W-9 is just tell me your name and address and taxpayer identification number, okay? Your best bet is if you're hiring someone that's providing services to your company, when they give you an invoice or ask you to pay them, ask them for their W-9. So I train my clients to say, thank you for that invoice. Please send me your W-9 and I'll get it processed for payment, right? Okay, the Ppp and Cares Act. So, and there was a new piece of legislation that was signed today as well. But there are second draw loans and they are available now. The current deadline is March 31st. You have to show a revenue reduction of 25% to qualify for the second draw loans. You also have to have an economic need. I want to talk about a couple of things here with this. So first, there was a lot of confusion about the 2-week period that ended on Wednesday, that ended yesterday. That was a special period where the SBA and Treasury were only going to process loans from employers with less than 20 employees, okay? The whole program for the second draw goes through the end of the month. So you have to have a loan. I'm actually not sure if it just needs to be submitted to a lender by the 31st or you have to be approved by the 31st, but you have another couple weeks, okay? And when I say couple, I mean like 2. The revenue reduction, so how you calculate the 25% is either quarter of 2019 versus the same quarter in 2020, or all of 2019 versus all of 2020. And you can use a couple of different things. So you can use your bank statement deposit totals. So on each one of your bank statements for each month in the quarter, there's a number that says the total amount of deposits that you made. But if you use your bank statement amounts for deposits, don't include your previous PPP loan or any money that you put into the business, or if you got an EIDL loan, which is the economic injury disaster loan, or the EIDL advance, okay? Those you would back out of your bank statement totals. I was actually helping a counselor at the Sbdc the other day because they were working with a restaurateur that had completely switched her business from being dine-in to third-party delivery services. But the third-party delivery services were taking, they probably didn't do this, but let's just pretend it was 30%. So right off the top, like her financial statements showed that she had all this revenue, but then she had this 30% cost. So he said, what am I supposed to do? And I said, you're allowed to use the bank deposits as a way to calculate the 25%, okay? The other thing, the economic need. So let's say that in first quarter of 2020, let's say in first quarter of 2020, when COVID happened, you were in an industry where you were uncertain about the future, right? So you went and borrowed a PPP loan. And then you, as like most entrepreneurs, you adapted to what was happening in the world and you pivoted your business and you found a line of service or a line of products that just killed it. And you grew your revenue in third quarter and fourth quarter by like 200%, okay? You're gonna have a really hard time documenting an economic need for a second PPP loan if you are like just killing it right now, okay? So you have to document, this is why I need this money. If you need the money, just write the note. Like write yourself a note. This is why I'm uncertain about the future. This is why I have an economic need, okay? But if you feel like you qualify and go apply. Okay, they also expanded the allowable cost. So now it's payroll cost, which is gross pay, including group insurance payments for vision, dental, disability, and life insurance now. Mortgage interest that was incurred before February of 2020. Rent or leases before February 2020. Utilities for services that were in place by February of 2020. And then covered operations expenditures, covered property damage costs, covered supplier costs, and covered worker protection. So one thing I want to say here, I have a client that actually is, they were given a grant to open a new restaurant location, okay? And so they're going to be able to do it without having to come up with a lot of costs themselves. But because that lease on that space wasn't in place on February 15th of 2020, that lease payment is not an allowable cost on their second PPP draw, okay? All right, so covered operations expenditures. There's a lot of words here, so I'm just going to read them and then we'll talk about it. Payments for any business software or cloud computing service that facilitates business operations, payment or service delivery, the processing, payment, or tracking of payroll expenses, human resources, sales or billing functions, or accounting or tracking of supplies, inventory, and records and expenses. So to me, this sounds like QuickBooks Online. I'm just going to tell you that. So I feel like if you're now using like a bunch of software as a service and you go online and you do all these things that you didn't do before, some of those cloud computing costs would be covered operation expenses. Covered property damage costs or costs related to property damage and vandalism or looting due to public disturbances that occurred during 2020 that wasn't covered by insurance or other compensation. I have a client in Portland, Oregon, and they're a restaurant group, and they have a location in downtown Portland that was near, like what we saw on the news. It was like a 3-block area that was probably about 4 blocks from my client's restaurant. So someone did break out a window one night, but their insurance company paid for it. Had their insurance company not paid for it, I could have applied the second draw of their PPP loan to that window replacement cost, okay? But since the insurance company paid for it, it won't be allowable this time. Covered supplier costs are costs made by the borrower to the supplier of goods for the supply of goods that are essential to the operations at the time the expenditure is made, or made pursuant to a contract or purchase order in effect at the time before the covered period, and if it's a perishable good, in effect before or during the covered period. So I'm just going to tell you, when I read this, like this to me, I don't know how any business owner ever spends money on things they don't see as essential to the operations at the time the expenditure is made. So I think there's a lot of gray area in this one. And maybe like Paula can help me at the end if there's some advice the Sbdc is giving their clients. But to me, this covered supplier costs, document your understanding about why you are claiming that towards your PPP funds and claim it. And then covered worker protection, operating or capital expenditures to facilitate the adaptation of the business activities of an entity to comply with some regulatory bodies during the period beginning on March 1st of 2020 and ending on the date in which the national emergency is finished. Examples of this include a drive-through window, air pressure, ventilation or filtration systems, physical barriers, and expansion of additional indoor or outdoor spaces, and on-site or off-site health screening. So that same client that we were talking about in Oregon is thinking about investing in a patio cover to make it so that they can have outdoor dining even now while it's 40 degrees and raining there. And mostly when I talk to them, I go neener neener because it's like 75 and beautiful here. So those costs, because they're expanding their outdoor space to that business owner, they think those costs will be covered by their PPP loan. Some of these costs, like I said, seem like they're going to fall into a gray area. Use your best judgment and document your thinking, okay? Just write it down. This is why I put it there. Any payroll tax credit that you claim for the COVID Family First Leave cannot be reported as PPP eligible wages. It's considered double dipping of federal funds. The COVID Family First Leave is that part of payroll where the IRS will reimburse you for up to 80 hours to have an employee stay home because they got COVID, or because a family member of theirs has COVID. You need to maintain good records. Keep copies of all your receipts and invoices, canceled checks, your contracts, your leases, all of those things. So in ordinary times, you would need to keep contracts or leases for the period that you deducted them on your tax return. You would do the same with the PPP loans. PPP forgiveness is not taxable at the federal level. It's not taxable income when it's forgiven or when it's given out, and expenses are deductible. Sorry, there's a typo there, but expenses are deductible at a federal level. So if you got a $50,000 PPP loan and you used all $50,000 on payroll, you still would write off $50,000 worth of payroll expenses. Arizona has not issued any guidance yet about if the PPP forgiveness will be taxable income or if the expenses will be deductible. I'm just going to say this here. In California, the state of California has decided that any expense that was reported as PPP money, so my $50,000 payroll, for example, that $50,000 is going to be taxable income. I'm sorry, that in California, that $50,000 isn't deductible in California on California state tax returns. Okay, at a federal level, yes, absolutely. In Arizona, at this moment today, everything's fine. It's all deductible. There's no issue. Okay, just know it could change. I don't think it will, but it could. All right, economic injury disaster loans, EIDLs. So many businesses are eligible to apply, and the EIDL loans, they are loans, so you have to repay them. Okay, that's the first part. There is an EIDL advance of up to $10,000. That is not taxable income, and that does not have to be repaid, but the loan portion does. So if you got the loan, and the max is $150,000, if you got the loan, that loan will need to be repaid. If you got the advance is not taxable and it does not need to be repaid. And then the last thing is employer retention credits. So couple of things. Your income must be reduced by 50%, not 25% like the PPP. PPP borrowers are eligible for the employer retention credit that changed in December. You can't double dip. So you can't use payroll for the PPP and payroll for the employer retention credit, the same payroll. There's a potential credit up to $7,500 per employee per quarter in 2022. That's the website. I'm just saying this here because not many people know about this. So the employer retention credit has been around for ages, and basically like it's there to help offset, the FICA tax that we talked about, the employee portion plus the employer portion. This $7,500 up to $7,500 per employee goes to pay those taxes. All right. It's measured per quarter. Your payroll company should be able to help you with this. Your tax accountant should be able to help you with this. And you don't have to do it right now either. So like my restaurant client that I was telling you about in Oregon, so they got a second draw PPP loan, like on the 29th of January it came in. So I'm gonna claim the employer retention credit for the payroll that they paid from January 1st to January 29th. And then let's say that their PPP money runs out on July 1st. So then I'm gonna claim PPP money from February, January 29th through June 30th. And then from July 1st to December 31st, I'll go back to claiming the employer retention credit, okay? So just know that this is something that's there. This isn't part of the CARES Act or COVID relief or anything like that. This retention credit has been around for ages. So you can go back and amend prior returns to get the credit refunded or applied to future periods as well. And you have until at this moment, for all of 2021, for example, you have until 2024 to submit for those credits. Okay, so you don't have to do it today, but know that it's there. All right. And then here's all my information. I think I went through that really fast. You guys probably have a million questions. So.
Let's see, I don't have any open questions in the Q&A, so if you do have a question, please be sure to put it in the Q&A so that way we don't lose it in the chat box. However, I was able to catch one, Tanya. And what someone was wondering if you can address the best practices for accounting for PPP funds in the financial statement, PPP loans on the balance sheet as a liability, and how can you handle forgiveness on the financial statements?
So on the financial statements, when you get your PPP loan, whether it's the first one or the second one, it's a liability, in my opinion. So it goes on your balance sheet as a loan. And then when it's forgiven, you move it from your balance sheet to your income statement or profit and loss and create a brand new account that says, you know, PPP forgiveness or something, make it an other income type in QuickBooks. And if you're not using QuickBooks, send me an email and tell you what to call it, but make it an other income type. And so then it will show way below the line on your income statement. Even though it's going to show in your profit and loss or your income statement for the year, it doesn't get reported on your tax return, okay? Think about like meals and entertainment, for example. Like meals and entertainment generally are only 50% deductible. So even though 100% of it is a business expense and shows on our financial statements, only 50% of it will go on our tax returns.
All right, and so far that's the only question that I have. It looks like someone shared a resource about the employer retention credits from the Arizona Commerce Association. So if any of our participants have any additional questions for Tanya, please feel free to use the Q&A. We're going to go through a quick wrap up of these. So if you think of questions during the wrap up for Tanya, she will still be around. So please feel free to use the Q&A for that. And Paula, one of our Sbdc care supervisors, is joining us today, Paula Whittigan, and she will be sharing a little bit about Sbdc as we wrap up here and as you think about questions to ask for Tanya.
All right. Laura, do you want me to share my PowerPoint?
If you want to, I also have it up if that would be better for you.
Yeah, go ahead. I'll let you share it then. Sure. And I did post the link. So yesterday, the Arizona Commerce Authority, they have their boot camp series, and they had a great session yesterday on that employer retention credit, which goes into some details. So it's pretty complicated, as Tanya said. So if you're looking for some more information, that's a great resource. It looks like the recording is still pending. So if you click on that link, you'll see that it says it's still pending. So just want to share that with you if you need some more information. All right, so Laura, did you give any start to our services as you opened the session, since I joined a little bit late today?
No, we did not. We let them know that you would be joining us later, and so Tanya kind of just hopped right into hers.
Okay, great. Well, thank you, Tanya. Again, your information is always so informative. I always learn something new when I participate in one of your sessions. So just to recap, Sbdc services, for those who are not familiar with us, the Maricopa Sbdc is actually part of a national network. And of course, Maricopa Sbdc is part of the Arizona network. We have about 10 centers across the state and 17 plus counselors here in Maricopa County alone. And the main thing that we do offer is no-fee counseling. It's one-on-one counseling with our small businesses. So we're helping clients anywhere from I have an idea and don't quite know where to go next, to very established small businesses who, even though they've been in business for many years and, are very profitable, they still, need that small business counseling assist as they're growing their businesses. We're able to provide this service because we are funded by Maricopa Community Colleges here locally, and at the federal level by the Small Business Administration, and through our partnership with the Arizona Commerce Authority. So next slide, Laura. And this just very quickly is back one more. Just a snapshot view about some of the areas that we provide one-on-one counseling. Of course, we're still continuing to help our small businesses just navigate the changing landscape of the COVID funding. And of course, more changes coming. So if you do need some help in those areas, we're happy to assist you with that. If you're looking for capital and not quite sure where to go, we help our clients get lender ready and find the right capital resources. We do financial review. We offer marketing assessment and planning. We have experts in a wide range of areas: buying and selling businesses, manufacturing, technology, commercialization, export. And the PTAC group offers government contracting counseling. But this is just a snapshot view. Think of any area of business development. We have resources, counseling resources to help you. Next screen. As a client of Sbdc, we offer some free tools to you, actually. Our growth wheel that we license is really a business development tool that helps to guide our businesses and our clients in many different areas. It's templates and articles and just decision sheets to help you move your business forward in many areas. We offer access to LifePlan, which is a platform where you can develop your business plan, both that the narrative portion and also that financial forecasting piece, which can be very confusing, but LifePlan makes it very easy for you if you have a need for developing your business plan or updating your business plan. We have access to ProfitSense, which provides financial benchmarking data, and our IBIS Industry World subscription allows us to pull industry data reports for you, so you can see what's happening in your industry. There again, helping you plan for your business. And then our Sbdc Net marketing arm provides an additional resource for market research. So lots of great tools free of charge for you as a client of Sbdc. And requesting counseling is really easy. So if you're interested, go to the website there on the page and just click one more time, Laura, and we'll get that one graphic up in the middle. And really, once you complete that request for counseling form, the first step is an initial counseling session with a lead counselor. And then we schedule follow-on sessions really based on your need, depending on what you're working on with your business. So you might meet with a counselor more regularly initially, and then kind of get more into a standard routine of meeting every couple of months. But we do kind of base it on individual need. But really our long-term goal is to build a long-term relationship with you as you're building your business. And the next screen, and just a snapshot view of our upcoming webinars. Actually, this is an older slide, but we've got a couple of new programs coming up. We have a business tax seminar with, let me share my screen really quick, Laura, so we can show those updated programs coming up. So I'm going to click forward to, try and click forward to that screen. Whoop. Bear with me, oops. Here we go. So here are our upcoming programs. We have a getting ready to file your 2020 taxes on March 23rd. We have a new session on buying a business on the 24th of March. If you're looking for SBIRs, that's a grant program, how to leverage that seed fund. And we have our ongoing restaurant resiliency series. So if you are a restaurant, every month we have a program focused specifically on that industry. And then every month we also have a recurring session, a 30-minute session checking in with Chris, our digital marketing expert, on all things digital. So keep an eye on our calendar and you can register for those programs just like you did for this one. So we hope to see you at a future program. And please, I would encourage you to request counseling if you have a need for some services. And you know what, Laura, I'll just go to the next screen if that helps. Yes. And just to finish off, you can visit our webpage, and we do have a COVID-19 tab. And listed there we try to keep that up to date with local grants, information on those COVID funding programs, as well as other community resources to help you out. We talked about the training event calendar. And once again, I've listed the website link there. I would encourage you to follow us on our social media just to stay current on all the programs and stay up to date on changing information. And Laura, I'll let you take it from there.
Yep, and we did have one question come in for Tanya, just so you know, Tanya. We have a question about eVerify new hire reportings. Should you go back to do this if you did not do this within 48 hours? They just hired their first 2 employees.
Since it's new, I would say yes, just go back and do it. And it's going to ask you on eVerify why you didn't do it within 2 days. just put that you had to register. So.
All right. And it looks like those are all the questions we got in. Melinda, thanks you, Tanya, some great information. We also thank you so much for joining us and allowing time to present all of this great content. I know we are ending early because we had some concerns about being able to cover everything in the first time frame. So thank you so much, Tanya, for again joining us, and thank you all for joining us. There will be a survey as you exit out of this webinar. Please feel free to complete that. That will really help us better understand the information that you're looking for so we can better support you with the webinars that we are offering at the Sbdc. Thank you all for joining us today. We all hope you have a great day. Thank you, Tanya, and thank you, Paula, as well. Bye.